Greetings from our team at Robert and Jones Wealth Management. This is Jack Jones with our December monthly market update. Before we begin, thank you to our valued clients for the trust and confidence that you place in us. The best part of our day is time spent directly serving you. Thank you to those that attended. It was great to see almost 200. We were at capacity at our December client event at Perry's. Again, it was great seeing everyone in person. We were also very honored to work with a charity in our area where our clients generously donated hundreds of items to help those with special needs in our area. So again, thank you to all those that participated. It was great seeing you all there in person. We had almost 200 clients in attendance, and again, it was great gathering together with you. We also hope you've taken advantage of listening into some webinars that we've had throughout the year. We plan to continue that next year. The next one that you'll see an announcement on soon is on behavioral finance, and that one will be in January. So these were the headlines if you were recovering from Thanksgiving on Friday. That you may have seen in the shortened trading day. The Dow was down some 900 plus points with some COVID related fears. But what's interesting about where the markets have been since then, and they've quickly kind of shrugged what happened on Black Friday off, which is the worst Black Friday since 1931, and are now back to near all-time highs. Now, what's interesting in years like we've been through, where 3 consecutive positive years, it's only happened 3 times in history. And all 3 times, this is a look at the 4th year, which was overall positive. So again, we don't have a lot of history to go by in terms of the 4th year after 3 positive years in a row. But those 3 times in history that has happened before, the most recent one being 98, markets were positive. We've also seen volatility and retreat this year. Last year, there was 44 trading days where the markets were up plus or minus 2%. This year, thus far, only 6. So again, volatility that really punctuated the first half of the year last year has been in retreat in 2021. We've also seen a wide valuation spread between growth and value. What you'll see here is that the value measured by price earnings ratio is at 34 on large cap growth versus 18. What you see on the right here is that anytime there's a gap between these two of over 15, over the next 3 years, value outperforms by an average of over 17%. Now, of course, we don't know that this will happen going forward, but that gives you some historical context. Some other context is where this spread was before the dot-com bubble burst. So you see that spread was 45 versus 17. So almost twice as much spread then as now. But again, it's important to note that the valuation, which measures how expensive stocks are, the price earnings multiple is much higher on growth stocks versus value. The jobs report, the most recent one, added 210,000 jobs. The unemployment rate ticked down to 4.2. There's still 2 million approximately less people working now than pre-pandemic. And there's over 10 million jobs that are open. So kind of a mixed job report. Again, the unemployment rate did tick down. You did have average hourly pay also tick up, but inflation adjusted, you're losing ground here in terms of pay. And inflation is the big item of the day. We saw that consumer prices are now rising to an annualized rate of 6.8, which is the highest that we've seen in November. Related to inflation, we saw the Fed, when asked this question, has kind of changed their tone. And you see this quote directly from the Fed saying it's probably a good time to retire that word being transitory, and try to explain more clearly what we mean. So Clearly what the Fed is realizing, and we'll talk about response to that in a second, is that inflation is likely to be more persistent for a longer period of time. So you won't hear the term transitory from the Fed anytime soon. Not followed as much as CPI, which measures the goods and services that consumers buy, is what producers pay for. So this is a measure of wholesale inflation. That annualized is almost 10%, the fastest pace on record. So inflation on the consumer level and on the wholesale level is very hot, which leads us to this point. These were Fed comments from just Wednesday, 12/15, which is that the Fed is anticipated to aggressively dial back bond buying and sees as many as 3 rate hikes next year. So clearly this is in response to inflation that is not transitory, that is more permanent. And again, this is something that we're keeping a very close eye on. So with that in mind, we will close. We want to tell you Merry Christmas and Happy New Year. We want to tell you that we share these videos to keep you updated on the things that are impacting financial markets. This is no substitute for us talking about all of these items and how they apply to you personally. So if you have any questions about anything we discussed, please reach out to us. We look forward to seeing you in the new year. And if we don't see you again, Merry Christmas and Happy New Year.